Hello, everyone. A very warm welcome to you.
Hello.
We are genuinely grateful that you have chosen to spend your time with us today to watch this specific video breakdown.
Yeah, we know there are a lot of choices out there.
There are. The algorithm offers you a million choices, so we really do appreciate you investing your time here to get up to speed on what's really happening in the industrial world.
It is great to be here. And honestly, today is one of those days where the script gets flipped. We are looking at a company that, most people think they know.
Right.
But if you haven't checked in on them in, say, the last 6 months, you are looking at a stranger. It is February 2026, and we're talking about Eaton Corp PLC.
That's right. And look, I'll be the first to admit, usually when we talk about industrial giants, we're prepared for a conversation about incremental gains, maybe some cost cutting.
Well, dividend hike.
A dividend hike. Boring stuff. But Eaton just released their Q4 2025 earnings. And while the numbers are interesting, the headline news is actually kind of shocking. They announced a massive strategic shift regarding their mobility business.
Shocking is the right word if you haven't been paying close attention.
Okay.
But inevitable might be the better word if you have. This isn't just a quarterly update where they tell us they sold, 3% more circuit breakers. This represents a fundamental transformation. I mean, we're witnessing a legacy industrial giant one that we used to associate with truck transmissions and hydraulics morphing into a high-tech power management and aerospace leader. It's a complete restructuring of their identity.
So let's set the stage. We have a lot to get through. We are going to look at the presentation they gave, the numbers they posted, and this big strategic shift.
And then the Q&A.
Then we are going to go question by question through the Q&A session with the analysts, because that is where the management team really gets pressed on the details.
That is where the rubber meets the road.
That's exactly. So let's start with the biggest news right out of the gate. The strategic headline. The mobility spin-off.
Yeah.
Eaton has officially announced their intent to spin off their mobility business, which includes their vehicle and eMobility segments, into a completely standalone public company.
This is the headline for a reason. And to understand why they are doing this, we have to talk about something called the conglomerate discount.
Right. This is the idea that the market is just bad at valuing a company that does two completely different things. It doesn't know what box to put it in.
Exactly. Imagine you have a racehorse and a plow horse yoked together.
Okay.
The racehorse wants to sprint. That's Eaton's electrical and aerospace business. It's high growth, high margin. It's tied to the AI boom.
All the exciting stuff.
All the exciting stuff. The plow horse is the mobility business, trucks, cars. It's strong, it's reliable, but it's slow and it's cyclical.
Right.
When they are tied together, the market looks at the pair and says, well, they aren't fast and they aren't slow, so we'll just value them lower than both.
So by cutting the rope, you let the racehorse run.
Precisely. This move is all about a pure play strategy. The new Eaton will focus entirely on electrical and aerospace. These are the sectors the market loves right now. Data centers, grid modernization, commercial aviation, all the big secular growth stories.
And what happens to the plow horse in this analogy? Is the mobility business just being, dumped or left behind?
Not at all. And that's the nuance here that I think is important. The new mobility company is going to be a substantial entity. It will have approximately $3 billion in revenue right out of the gate.
That's a big company.
It is. It focuses on automotive and commercial vehicle markets. And by being independent, it can make its own decisions. It's not the forgotten stepchild anymore.
This touches on capital allocation, doesn't it? I mean, I have to imagine it's hard to get funding for a new transmission plant when the other division is screaming for money to build data center equipment.
Oh, that is the civil war for capital inside any conglomerate. The electrical business needs massive capital for R&D and capacity expansion to meet the AI demand. Just huge checks.
Right.
The vehicle business has different needs, maybe efficiency upgrades or specific EV tooling. By separating them, you remove the internal conflict. They don't have to fight for the same dollar anymore. Each company can pursue its own best strategy.
And it's worth noting, this isn't Eaton's first rodeo with this kind of thing.
Not at all.
They spun off the lighting business in 2020 and then hydraulics in 2021.
Right. This is the final step in a long-term plan to clean up the portfolio. They are systematically removing the cyclicality to reveal this high-growth core that was kind of hidden underneath.
So that's the strategy. Let's look at the scoreboard now, the financial performance for Q4 2025. Because if you want to know why they're spinning off the vehicle business, the numbers basically scream it at you.
They really do. Let's look at the highlights. Adjusted earnings per share, so EPS, Came in at $3.33.
And that's up 18% year over year.
18%.
18% earnings growth for a company this size is nothing to sneeze at. That's fantastic.
It's impressive. Segment margins hit 23.9%, up 20 basis points. And organic growth was 9% overall. But, and here's the kicker, this is the whole story in one number.
Okay.
Paulo Ruiz, the CEO, explicitly stated that organic growth would have been nearly 12% if it weren't for weakness in the vehicle segment.
There it is, the 9% tap, 12% gap.
That's it.
That is the cost of keeping the businesses together right there in plain sight.
Exactly. You have a stark divergence. Electrical Americas and Aerospace are booming. We're talking double-digit growth. Vehicle markets, on the other hand, are softening. They are in a down cycle. So the vehicle business is effectively an anchor, just dragging down the top-line growth of the whole company.
Okay, so we've established that the vehicle business is the anchor. Now let's talk about the rocket fuel.
Yeah, let's.
The mega project and data center boom. The company used the phrase tremendous strength to describe demand. And I feel like tremendous is a word CEOs use when things are, just okay. But the numbers here seem actually tremendous.
They are. They really are. Let's look at the data points because they're pretty wild. Electrical Americas orders are up 16% on a rolling 12-month basis. The backlog grew 31% to an all-time record.
Okay, strong.
But the number that made my jaw drop was data center orders. They accelerated approximately 200%.
Wait, 200%?
200%.
In 1 year.
And sales were up 40% in Q4 alone.
Yep.
Okay, I have to play devil's advocate here for a second. When I hear 200% growth, my brain immediately screams, I think double ordering, panic buying. Are these real orders, or is this just hype that's going to evaporate in 6 months?
That is the trillion-dollar question, isn't it? And it's the right one to ask, but you have to look at the context. The global backlog for mega projects, these are projects worth over $1 billion, is at $3 trillion.
Trillion with a T. With a T. That's up 30%. But the most insane stat they dropped was about the U.S. data center construction backlog. They said it represents 11 years of work at current build rates.
Hang on, let me just process that.
Yeah.
11 years. So if nobody signed another contract for a new data center starting today, they'd still be building for over a decade.
Theoretically, yes. That's the backlog.
But isn't that a risk in itself? I mean, in the tech world, 11 years is an eternity. Who knows what chips we will be using in 2037? What if the technology completely changes and all this electrical gear they're selling becomes obsolete?
That is a valid fear, and it's one analyst brought up. But you have to look at what Eaton sells. They aren't selling the chips. They're not NVIDIA. They are selling the physics of electricity. Whether you have an NVIDIA H100 chip today or some quantum processor from the future, you still need to get medium voltage power from the utility grid to the building. You still need transformers. You still need switchgear. You still need busways.
So the pipes don't change, even if the water running through them does.
Exactly. And the bottleneck right now isn't the technology. It's the physical world. It's concrete. It's zoning permits. It's labor. It's getting the utility to connect you. That 11-year backlog is a reflection of how hard it is to actually build these massive facilities. The demand is far outstripping the physical ability of the world to construct them.
Speaking of the difficulty of building, that brings us to the operational side. Because Eaton has to build the stuff to sell the stuff.
Right.
They call it their invest-to-win strategy.
Right. And you can't fulfill 200% order growth with the same factories you had 3 years ago. It's just not possible. Eaton is currently pouring $1.5 billion into capacity expansion.
That is a massive check to write for an industrial company.
It is. Paulo Ruiz calls it a good challenge, but, for investors, it creates a short-term problem. It creates what they call margin friction.
Okay, explain that for the non-accountants listening. What's margin friction?
Sure. Imagine you are opening a new restaurant. You have to rent the building, you have to renovate the kitchen, buy all the stoves, and hire the chefs before you sell a single burger.
Right. All your costs are up front.
Exactly. For those first few months, your costs are huge and your revenue is zero. Your profit margin looks absolutely terrible.
And that's where Eaton is right now with these new factories.
Partially. They are swallowing the whale, as they say. They are ramping up factories at a pace they've never done before. They are hiring thousands of people and training them, which costs money.
Yeah.
They are depreciating all these new machines. This drags down their profit margins today in exchange for massive revenue tomorrow.
And they are also buying companies to speed this whole process up. They mentioned FiberBond ResilientPowerSystems UltraPCS, and a pending acquisition of a company called BoydThermal.
BoydThermal is the critical one, and we are going to talk a lot more about that in the Q&A section because it completely changes their position in the cooling market. It's a huge deal.
Okay. Before we get to the Q&A, let's just wrap up the presentation with their 2026 guidance. What are they telling us to expect for this year?
They are guiding for organic growth of 7-9%. But again, for the star pupil, Electrical Americas, they expect 10% growth. Adjusted EPS is guided between $13 and $13.50. At the midpoint, that's a 10% increase. Still very strong.
And what about share buybacks? Usually companies love to sprinkle some buybacks in there to boost the stock price.
Not this year. No share buybacks planned for 2026.
Why not?
Because they need the cash for that Boyd acquisition. They are prioritizing strategic growth buying companies and building factories over financial engineering. And honestly, given the growth rate they're seeing, that is exactly what you want a company to do. You want them investing in the business, not just retiring stock.
And finally, a note on the team. The CFO, Olivier Leonetti, is leaving in April.
Yes. And that's always a bit nerve-wracking when a CFO leaves during a massive transformation like this. But they emphasize a smooth transition. The strategy seems very firmly set by the CEO, Paulo Ruiz, so I don't think investors should be too worried. The course is set.
Okay, so that's the pitch. Everything looks rosy, the growth is incredible, the strategy is clear. But now we move to the Q&A session analysis. This is where the analysts try to find the cracks in the armor. And honestly, they asked some very specific, very technical questions this time.
They did. They really dug into the mechanics of the data center, which was fascinating.
Let's start with question 1 from Andrew Obin at Bank of America.
Andrew is a veteran. He's been covering this space for a long time, and he went straight for the jugular on 2 points.
The inquiry. So first, he wanted context on their confidence in that double-digit data center growth. It's basically the same question I asked. Are you sure this isn't a bubble?
The polite analyst version of it, yes.
And second, he asked a very specific technical question about liquid cooling, referencing NVIDIA and recent market developments.
And that second part is key. There has been a lot of chatter in the market that new chip designs might change how cooling works, potentially hurting companies like Eaton who are in that space.
The company response. So, let's break down what Paulo Ruiz said. On the growth confidence, he didn't blink. Not for a second.
No. He cited that industry announcements for new projects are up 200%. He re-emphasized that the hyperscalers, your Googles, Microsofts, Amazons, have all reconfirmed their CapEx plans. They aren't pulling back.
But the fascinating part to me was this liquid cooling deep dive. He used this terminology of inner loop versus outer loop.
We need to unpack this because it sounds like jargon, but it's actually physics.
It is. It's actually a great way to think about it.
Yeah.
Think of a data center like your house in the middle of a really hot summer.
Right.
You have an AC unit sitting outside in the yard, right? The big box with the fan. That is the outer loop. Its job is to take the heat from inside the building and dump it into the atmosphere.
Simple enough. Big chillers on the roof of the data center.
Right. But now, imagine your computer inside the house is running so fast it's about to melt. The air in the room isn't enough to cool it down.
So you strap a water block, it looks like a little car radiator, directly onto the computer chip. You pump liquid right over that hot surface to pull the heat away much more efficiently. That is the inner loop.
Okay, so direct contact cooling. And historically, Eaton just powered the big AC unit outside the outer loop, right?
Correct. But with the Boyd acquisition, they are moving inside the computer. They are now making the cold plates and the coolant distribution units, the CDUs, that actually touch the chip.
So Andrew Obin's fear, the market's fear, was that if the chips get hot enough, maybe we don't need the big AC outside anymore. Maybe the inner loop does all the work.
That's the theory. If the inner loop is efficient enough, maybe the outer loop shrinks. But Paolo's point was brilliant. He basically said, we don't care.
Why not?
Because even if the chiller market shrinks, the inner loop market is exploding. The hotter the chips get, the more sophisticated and expensive the cold plates and manifolds have to be.
And that's the business they just bought with Boyd.
That's the business they just bought. So it's a net positive for them. He actually put a dollar figure on it, which is amazing.
He good.
He said, currently, Eaton captures about $2.9 million in content per megawatt of data center capacity.
Okay.
But with the new AI loads and the Boyd acquisition, basically, by owning the inner loop, that accessible market for them jumps to $3.4 million per megawatt.
So they're capturing more value by getting closer to the chip.
Exactly. The hotter the chips get, the more money Eaton makes. It completely flips the risk on its head.
Moving on to question 2 from Chris Snyder at Morgan Stanley.
Chris was doing what good analysts do. He was looking at his spreadsheet and noticing the math looked a little lopsided for 2026.
The inquiry. He asked about the quarterly cadence of EPS. Basically, why does Q1 look so low compared to the full year? And he also asked about those massive capacity investments. Specifically, when does the pain stop and the gain begin? When does this turn from a headwind into a tailwind?
This is a classic model hygiene question. Investors hate it when a year is backloaded because it just increases the risk of a miss later on.
The company response. Paulo Ruiz and Olivier Leonetti, the CFO, teamed up on this one. And they were very transparent. They said to expect 44% of the EPS in the first half of the year.
And 56% in the second half. That is a very, very heavy skew to the back half of the year.
So why? What's driving that?
2 main reasons. First one is simple, taxes. Their tax rate is going to be higher in the first half, around 20–21%, and then it's expected to drop in the second half to 16–17%. That's just math.
Okay.
But the second reason is the operational one we talked about earlier.
The factory ramp. The restaurant analogy.
The restaurant analogy,
Right.
right. They are hiring people now in Q1. They are paying salaries, they're paying for training, and they're depreciating all this new equipment. But those factories won't be producing at full revenue capacity until Q3 or Q4.
So you have all the costs of a big company, but the revenue of a smaller one for the first 6 months.
Exactly. And they actually quantified the drag from this.
They did.
They said the ramp costs will drag margins down by 130 basis points in 2026.
That is a huge anchor to drag around for a full year, 130 basis points.
It is, but think about how strong the core business must be. Even with a 130 basis point penalty, they were still delivering segment margins around 30%. That just shows you the incredible underlying pricing power they have.
So what was the timeline they gave when this flips?
They were pretty clear. They said expect progress in Q2, see real momentum building in Q3, and then strong backlog liquidation, which is corporate speak for shipping a ton of product out the door in Q4 and heading into 2027. So the takeaway is 2026 is a building year. 2027 is the payoff year.
Next up, we have question 3 from Nigel Coe at Wolfe Research.
Nigel was asking the question that I think everyone on the call was thinking but was maybe afraid to say out loud. Are you guys sandbagging us?
The inquiry. He asked for some more specifics on Q1 margins, but the real question was about the long-term targets. He asked about the portfolio changes, the spin-off, plus this insane data center boom impact, the 6–9% growth framework they established a while ago.
He's basically saying, guys, you told us you'd grow 6–9%, but you just said data centers are growing 200%. Your math doesn't add up. Your targets are obviously too low.
The company responds. And the company, they basically admitted it. Paulo Ruiz was surprisingly candid.
He was. He admitted the current long-term plan, or LTP, is conservative. He pointed out a couple of things. First, the old plan only assumed 17% data center growth.
Which seemed aggressive at the time.
It did, and now the reality is wildly higher. Plus, he said the old plan didn't account for the spinoff, and it didn't account for buying Boyd or UltraPCS. It's just an outdated model.
And why not raise the targets now?
Yeah.
Why not come out and say we're a 15% growth company now?
Because of the short-cycle businesses. Things like residential housing and industrial machinery, those parts of the economy are still a little shaky. Paulo said they want to see those fully recover before they go and update the big 2030 targets.
It's the classic under-promise, over-deliver strategy.
Exactly. They prefer to beat and raise every quarter. If they set a massive target now and say the housing market crashes, they look stupid. If they keep the target where it is and crush it every single quarter, they look like geniuses. It's just smart management.
Very smart. Next, we had question 4 from Nicole DeBlaise at Deutsche Bank.
Nicole wanted to make sure Eaton isn't becoming a one-trick pony, that it's not all just about data centers.
The inquiry.
Yeah.
She questioned the margin step down in Q1 again, just to be sure. But her main question was about order trends in non-data center verticals. Because, Eaton does other things besides power AI chips.
It's an important check.
The company responds. Paulo confirmed again the margin issue was the ramp costs, but on the other verticals, he highlighted a couple of really interesting unsung heroes.
Utilities was one. Orders are up low teens. This is driven by grid hardening.
Right.
Basically, making the grid tough enough to withstand storms and, more importantly, handle all this new electrification from EVs and data centers. The grid itself needs a massive upgrade.
But Aerospace seems to be the quiet overachiever here. It kind of gets lost in the data center hype.
It really is. While everyone is screaming about data centers, aerospace sales are up 20% organically. and the margins there are expanding beautifully.
Is that new planes or old planes driving that?
It's both, but the aftermarket, so spare parts and maintenance for the existing fleet of planes, is particularly strong. This is crucial because aerospace provides stability. It's the ballast in the ship. When the tech sector gets volatile, people still need to fly planes, and those planes still need parts.
And what about the weak spots, the short cycle businesses?
He mentions seeing green shoots. That's the classic corporate way of saying it's not getting worse, but it's not great yet. They are seeing some early signs of recovery in industrial machinery and residential, but they're staying cautious.
Okay, finally, question 5. From Dean Dre at RBC Capital Markets.
Dean asked a great question about the quality of the orders. Not just how many, but what kind.
The inquiry. Yeah, he asked about the data center order mix. Was it hyperscale versus co-location? He asked about the split between traditional cloud versus AI. And he asked about panic buying, those 5-year supply agreements we heard so much about during the pandemic.
A lot of good questions packed into one.
The company response. Paolo said the customer mix now is very balanced. It's not just one hyperscaler driving everything, it's all of them, plus the multi-tenant co-location guys. But the cloud versus AI split was the really fascinating part.
It was. This was a key insight. He said that in 2025, the orders they took were 50-50 cloud versus AI.
50-50.
But in 2025, the revenue they recognized was still 70% cloud and only 30% AI.
So what does that discrepancy tell us?
It tells us there is a massive lag. The AI boom is showing up big time in the order book, but it hasn't fully hit the bank account yet. It means the AI revenue wave is still coming and it hasn't even crested yet. We're still in the early innings.
And on the panic buying, are customers still hoarding equipment?
He said those days are over. The multi-year lock-in-your supply agreements are gone. Customers are now ordering in a much more disciplined 12 to 18-month window.
Why the change?
Because they trust Eaton's capacity expansion. They see these new factories being built, so they don't feel the need to hoard circuit breakers like it's toilet paper in 2020. It signals a much healthier, more normalized market dynamic.
And briefly, he touched on the 800-volt transition.
Yes, just a quick point. As chips get more powerful, you need higher voltages to move power around efficiently. He confirmed Eaton is leading that technology with their Resilient Power Unit and is actually helping to write the industry codes and standards for it.
So we've dissected the presentation and the interrogation from the analysts. Let's try to pull this all together in a high-level wrap-up. If you are an investor or just an industry watcher listening to this, what are the main themes you should take away?
I think it boils down to 3 main themes for me.
Okay, go for it.
Theme number 1 is simply transformation. The spin-off of mobility clarifies the identity of Eaton. They are no longer a confused conglomerate. They are a power and aerospace company, pure and simple. The story is clean now.
Theme number 2?
Generational growth. You know, we throw that term around a lot, but when you see 200% order growth and an 11-year backlog, it actually fits. And crucially, it's not just volume. AI is driving higher dollar content per megawatt. They are capturing more value from the same footprint.
More value, not just more sales.
Yeah.
And theme number 3 has to be about the short-term pain, right?
Yes. Let's call it execution pain. They are swallowing the whale right now. Margins are being artificially suppressed because they are spending billions to build these factories.
But that creates a coiled spring.
Exactly. It creates a coiled spring. They're suppressing profit today to release, theoretically, massive profitability in 2027 and beyond when that revenue comes online without the startup costs.
Yeah. So if you are watching Eaton, you're watching a company that is intentionally taking a hit right now because they believe it will allow them to dominate the next decade.
That is the bet. And so far, the order book says it's the right bet to make.
Well, that brings us to the end of our breakdown. I want to thank you again for watching this video. We hope this gave you a clear, detailed picture of where Eaton stands as of February 2026.
It's a complex story, but a really fascinating one to follow.
If you found this analysis helpful, please click that like button. It really does help us out with the algorithm. And consider sharing this video with colleagues or investors who are interested in the industrial and tech infrastructure space.
And don't forget to subscribe so you don't miss our next breakdown.
Stay tuned for upcoming content covering similar earnings analyses. Thanks again for watching.